Ladies and gentlemen, welcome back to part 2 of our video. If you haven't watched part 1 yet, be sure to check it out for the foundation of our discussion. Ladies and gentlemen, gather around and prepare to embark on an unforgettable journey into the exhilarating world of stocks and financial wizardry. Welcome to Stock Marketpedia, where the stock market meets showtime. Let's kickstart this electrifying adventure together and redefine what it means to be the stock market superstar. So without further ado, hit that play button, fasten your seatbelts, and let the financial extravaganza begin. Get ready for a wild ride because Stock Marketpedia is here to rock your world. Style number 2, value investing. Value investing is a style of investing that helped Warren Buffett become wealthy. While it may not make everyone a billionaire, it can still bring in good profits if done right. The main idea behind value investing is buying stocks at a price lower than their actual value. It's like finding great deals at a stock market sale instead of at regular stores or garage sales. Now, you might wonder how we know if a stock is cheap. Is it simply a matter of looking at the price and seeing a 20% drop as a bargain? Unfortunately, it's not that easy. When the price of a stock goes down, it often means the value of the business has also decreased. The key to value investing is figuring out the intrinsic value of a business. Once you know the value, you can compare it to the stock's price to see if it's a good deal or if you're being taken advantage of. It's actually not too difficult once you understand how it works. Essentially, you analyze different stocks and repeatedly compare their prices to their values. This is exactly what Warren Buffett did when he was younger. Although he didn't have the internet back then, he used the Moody's manual. He went through it twice, studying different businesses and searching for companies that were undervalued, meaning they had high value but were selling at low prices. Keep in mind that there are many stocks in the stock market, and value investing requires careful analysis and comparison. It's about finding hidden gems that are undervalued while avoiding stocks that are overpriced. Remember, value investing doesn't guarantee instant riches, but with dedication and smart decision-making, it can lead to positive results over time. P/E ratio. The price-to-earnings ratio, or P/E ratio, is a financial metric used to evaluate the valuation of a company's stock. It's calculated by dividing the market price per share of a company's stock by its earnings per share, or EPS. The P/E ratio is a widely used measure for determining whether a stock is overvalued, undervalued, or reasonably priced. The P/E ratio provides insight into how much investors are willing to pay for each dollar of a company's earnings. A high P/E ratio suggests that investors have high expectations for future growth and are willing to pay a premium for the stock. On the other hand, a low P/E ratio may indicate that investors have lower growth expectations or that the stock is undervalued. It's important to note that P/E ratios can vary significantly across industries and companies, so it's essential to compare the P/E ratio of a company to its peers or industry average to get a better understanding of its valuation. Investors use P/E ratios as part of their analysis when making investment decisions, but it should not be the sole factor considered. Other fundamental and qualitative factors such as a company's financial health, growth aspects, industry trends, and management quality should also be evaluated to make a well-informed investment decision. Value stocks example. When looking for value stocks, it's helpful to check their P/E ratios. P/E stands for price-to-earnings ratio, which compares the stock's price to its earnings. A low P/E ratio means the price is cheap compared to the earnings, while a high ratio means the price is expensive relative to the earnings. You can easily find the P/E ratio on platforms like Yahoo Finance. For example, Coca-Cola has a P/E ratio of 29, meaning the price is 29 times higher than its yearly earnings. It would take about 29 years to recoup the investment if their earnings stay the same. To assess if a P/E ratio is high or low, compare it to the market's average P/E ratio. Currently, the market's average is around 29.3. In Coca-Cola's case, its ratio is close to the market average, suggesting it's neither significantly cheaper nor more expensive. So Coca-Cola is better suited for dividend investing rather than value investing. Remember, when identifying value stocks, P/E ratios are useful, but it's crucial to consider other factors too. Analyzing and comparing stocks thoroughly is important for finding those that offer good value. In essence, value investing aims to find undervalued stocks with long-term growth potential. Style 3, growth investing. Growth investing carries more risk but offers the potential for higher returns. Take Cathie Wood as an example. She follows an innovation/growth investing style and has achieved an impressive average annual return of 39% over 7 years, 3 times higher than the S&P 500. To succeed in growth investing, we must assess where a business is heading in the future. Is it innovative and disruptive? Will it be the next Tesla, revolutionizing the car industry? Or will it be obsolete like textile businesses in the 70s or video rental and newspaper businesses in the 2000s, which were overtaken by innovation? It's crucial to identify the companies that will be game changers in the next 5 to 10 years. Some promising industries for the future include artificial intelligence, automation, robotics, self-driving cars, blockchain, and more. These sectors have the potential to transform the way business is conducted. Many growth investors are focusing on these areas for their investment opportunities. While growth investing can yield significant profits, it's important to carefully evaluate the potential risks and rewards. Stay informed, think critically, and identify the companies driving innovation to make informed investment decisions. Revenue, return on equity, profit margins. In growth investing, it's crucial to analyze a company's financials before making an investment. While popularity is important, it's equally vital to ensure that the company is generating profits. Revenue, which represents the total income generated by a business, is a key figure to examine. By checking the revenue growth, we can assess the company's financial performance. For example, Tesla, a popular stock, shows consistent revenue growth each year as seen on platforms like Yahoo Finance. Furthermore, analyzing revenue estimates for the future provides insights into expected growth rates. Return on equity, or ROE, is another important metric to consider. It measures the company's profitability in relation to its shareholders' equity. A higher ROE indicates greater profit potential. On Yahoo Finance, scrolling down to the statistics section reveals Tesla's ROE of 15.6%. While this figure may seem favorable, it's essential to compare it with competitors for a better perspective. Profit margins are also useful indicators of a company's effectiveness. For Tesla, the profit margin stands at 7.4%, implying that $7.40 in profit is generated for every $100 in revenue. To gain a clearer understanding, it's necessary to compare these figures with those of rival companies. For instance, Tesla surpasses its competitors in both profit margin and ROE. Comparing Tesla to NEO, Ford, Volkswagen, and Nikola shows the company's competitive advantage. Elon Musk's leadership and strategic decisions have contributed to Tesla's strong financial performance. Additionally, some growth investors consider the historical stock price trend. By analyzing the stock's past performance, investors can identify upward trends. For example, a search for Tesla stock on Google looking at the past 5 years reveals a consistent upward trend. However, it's important to note that the past performance does not guarantee future success. In conclusion, growth investors must dig into a company's financials before making investment decisions. Assessing revenue growth, return on equity, profit margins, and comparing them to competitors can provide valuable insights. It's also worth considering the historical stock price trend. Although it should not be the sole basis for investment decisions, by conducting thorough analysis, growth investors can make informed choices and increase their chances of success. Growth stock examples. When exploring innovation stocks, there are several exciting options to consider. Coinbase, for example, is a cryptocurrency exchange platform, offering exposure to the blockchain sector without directly investing in individual cryptocurrencies. Intelligent Therapeutics is another intriguing company focused on genome editing and developing cures for diseases. Palantir, founded by Peter Thiel, uses software to enhance business decision-making and has a successful track record with previous ventures like PayPal and early investments in Facebook. Tesla, the electric car company, is also worth mentioning, but it's important to note that its substantial market cap of $1.1 trillion limits its potential for significant growth. Ideally, it's best to invest in stocks before they gain excessive attention from mainstream media, such as when they start gaining momentum and are discussed on smaller platforms like Reddit or specific Discord groups. Investing early in these promising companies offers the potential for substantial returns, sometimes even reaching 10, 20, or even 100 times the initial investment. Choose an investing style that suits you and learn as much as you can about it. It's also beneficial to learn about different investing styles and take valuable insights from each one. Start by investing in a few stocks, even if you make mistakes along the way. Making mistakes is okay and part of the learning process. Gradually, you'll become more skilled at investing and may even reach a point where your investment portfolio can support your retirement. That's the ultimate goal in investing. Wishing you the best of luck on your stock market journey. That's a wrap for today's video, but the excitement doesn't stop here. Get ready for more mind-blowing content coming your way. We'll be pumping out videos 3 to 5 times per week, so buckle up for an exhilarating ride. Drop your comments below with your topic requests because we want to hear from you. And don't forget to smash that like button, subscribe, and hit that notification bell to stay in the loop. Stay tuned for the next thrilling episode on Stock Marketpedia, where we make stocks sizzle.